Okay, very good morning. Welcome to the briefing then for Thursday the 7th of July. Looking at the markets this morning, seeing some relative risk on sentiment. Looking first of all at the FOMC minutes we had last night. Let me just get my cursor. So looking at the S&P here on the bottom left to when the actual minutes hit last night. We're talking 7 o'clock. You can see here really minimal reaction on the actual candle itself. We did move higher in towards the latter part of Wall Street trade, but that was predominantly driven by gains in crude oil rather than anything the FOMC said. Similar as well with the US 10-year. Looking at yesterday, 7 o'clock, that candle there, bit of whipsaw price action, but overall very minimal movement on the back of the Fed. That was as expected. Again, we weren't really looking for much. The minutes overall stated that almost all Fed officials saw May payrolls increased uncertainty and went on to state that it's prudent to wait for the consequences of the UK vote. Again, just remember this came, I think it was about 10 days, this actual meeting that the Fed held before the actual EU referendum vote. Also, the majority of analysts had already highlighted that the minutes would appear more outdated than usual given the recent Brexit vote, which hence led to the more muted reaction. So not really too much to dwell on with the minutes from the Fed. They were largely a non-event. There's bigger focal points, if you like, for the US coming up today. We'll get into, we've got ADP for one, and then non-farm payrolls on Friday, which is going to be key for the markets. Taking a look though at oil, let me just make this chart a bit bigger. This candle here, 9:30, that was the release then of the API crude oil inventories. Remember, they were a day later given the US Independence Day holiday, and we surged higher on the back of that. You're looking at a pretty decent move for that time of day. Going from 47.41 up to 95 at the high, so just shy of the $48 handle. After 6 straight weeks of drawdowns and against expectations of 2.5 million barrel build, API reported a massive 6.736 million drawdown. So again, expected was for a drawdown of 2.5 million. We had a drawdown of 6.7 million. Much, much larger than expected drawdown. Actually, it was the biggest drawdown we've had since June of 2015. Cushing was a minor build, 80,000, but gasoline, sizable draw, 3.6 million. Distillates, a draw of 2.305 million. So some pretty bullish numbers there. Very minor build in Cushing, but overall the headline dominating. Almost 3 times deeper drawdown than consensus estimate, and hence we had that big pop higher. We've retraced it slightly overnight, but where we are at the moment, we're up 25 cents. I would say until the DOE numbers hit, barring anything unexpected, I'll be looking for that kind of 48 to pivot to kind of contain probably the price action as a defined range until those numbers hit. Obviously, the market now is positioned for a more bullish report given the APIs last night. So if that materializes, then I think we will see another test on 48 on the upside if that occurs later on today. But until that time, remember those numbers hit at 4 p.m, not 3:30. They're always half an hour later than normal when that's pushed back a day for US holidays. So 4 o'clock, watch out for those DOEs. There's been a pretty tight correlation with the performance of oil and that translating into the equity direction, so that'll be something to keep an eye on. Because certainly looking at the equity markets this morning, the SPUs helped out by some of the increase in oil seen late yesterday, and then this morning we're already trading up towards, well, slightly longer dated here, that 2100 handle psychologically. Obviously that's one to just watch on the upside from this current price action, and then the high print that we had back on the 4th of June at 04 3/4. And then above there, obviously the kind of high we had just before the Brexit vote lies at 21.19.5. So I guess 2100, your next kind of main target there on the upside, should we continue this upward move that we've seen so far this morning. Take a look at a couple of other stories though of note, and just to explain and clarify a few things. So the tally of UK property funds suspending redemptions this week has now increased to 7 yesterday, with Bloomberg suggesting that covers now £15 billion of assets. To kind of put that in context, the total size of retail UK commercial property market is around £25 billion, according to the FT. So more than 60% of it has been gated in 3 days this week. So I know 7 doesn't sound a lot, nor does 15 billion, but in the context of the space and its size, again, it's over 50%. So for any of the newer guys, what actually has happened and what does property fund suspensions mean for investors? Well, a fund will suspend redemptions when it cannot liquidate its assets as quickly as investors are demanding their cash back. So if you think about it in terms of open-ended funds investing in UK property, it's a combination of holding your portfolio in liquid assets, so let's say cash or shares in real estate investment trusts, and then allowing them to meet daily redemption requests. But when lots of investors withdraw, the funds, in terms of a cash level, gets obviously depleted. And to cope with further outflows, funds need to begin selling properties. So the key difference here is between liquid and illiquid assets in which this fund or portfolio might hold. Now, cash is fine, you can distribute that, but selling a property doesn't happen overnight. And so then that's the problem you kind of run into. And at that point then, if property takes time to sell, then until they do sell it, they won't have enough cash to return to investors. Hence they put a block on the fund, so to speak. One thing to keep in mind is that we've already known this referendum was coming for a while, so actually UK commercial property has had its largest outflows since the start of the year. It's been a predominant theme for a couple of months building up, but withdrawals have increased, obviously, since the EU referendum result and the vote to leave, which we all know now. One thing to keep in mind, why hasn't the market then, equities, why aren't we tanking? Why aren't we getting hit? And why isn't risk-averse trade then dominating on the back of this kind of these pretty seismic changes that we're seeing in investment behaviour, so to speak? Well, you heard the Bank of England. If you remember, Mark Carney spoke a couple of days ago, and to mitigate these risks, they were talking about relaxing requirements for capital buffers. So you can see now how this picture is starting to formulate, and how the Bank of England's trying to negate any of a run on banks or a downward move in sentiment, and therefore foreign investment into this country. Because by relaxing requirements of capital buffers, basically you're giving banks around £150 billion boost in what the programme is, which he announced. That means then you keep the system liquid, you avert any kind of credit freezing, you keep greasing the wheels, if you like, in what would be otherwise an economic downturn. So these are ways and means in which the Bank of England, central banks, look to kind of help out, if you like, economic movements that we see. Okay, quick look at some other things that I've seen this morning. Another quite worrying graphic, but just to show to you, it's not a major piece of data, but certainly shows what kind of state we're in at the moment. Brexit blues, the gauge of business sentiment. This is the Lloyd's Business Barometer, which came out overnight. That fell to a 4.5-year low. You can see here that economic optimism is pretty much the lowest it's been in, as I say, 4.5 years. So the ramification now of Brexit continues to sort of make some headway, and so these are indicators to look out for. And looking at the Eurozone, obviously there's been a big thing about contagion, big kind of risk whether this spills over to Europe, and Italy has been the one in question so far this week for sure. One interesting thing though, Italian bank shares have rallied quite hard this morning. As with any asset, once it moves down, large double-digit percentages, it's not uncommon to see quite a snapback before potentially then another push lower. One thing that's particularly interesting in the case of Italy is you've had some new opinion polls which have come out overnight. So the populist 5-star movement, which, if you remember, in the municipal polls or municipal elections we had in Italy a few weeks ago, made some pretty clear headway. But they've emerged as Italy's leading political party, overtaking PM Renzi's ruling Democratic Party in 4 separate opinion polls. Now, this is really worrying from an Italian perspective, because not only do they have, as we've been discussing this week, an extraordinary large amount of non-performing loans, bad debt at their banks, which is much higher than any other European country for sure, is that politically Renzi is really under pressure at the moment, and 5-star movement is a very anti-Europe, so Europe skeptic party. And if that starts to come into play on the back of the kind of populist movement, that they could gain traction given the vote that we've seen to leave Europe from the UK, then this could again just increase the uncertainty around Italy. So things like the peripheral bond spreads I'd be watching. As I was saying yesterday, Italian bank stocks are highly sensitive to market sentiment. I'll be also watching those very closely as well to kind of guide me through how the markets may move. Quick look elsewhere. You have had some data this morning. German industrial production. Again, talking about this potential European contagion effect. We had German factory orders yesterday, which were much worse than expected. And now you've had the German industrial production, you can see here, minus 1.3%. The lowest we've had in some time. So, if the economic engine, so to speak, in Europe, Germany starts to slow down, then things start to get a bit more worrying as well from that regard. At the moment though, just looking at these charts as I'm speaking, Bund futures are just making another push to the downside, Treasuries following suit. Again, with these equity markets continuing to be supported by just generally, I guess, some of the knock-on effects of oil helping lend its hand. As I said, there's a lot of negativity surrounding these market moves at the moment, but the message we've had from the central banks has been clear, certainly from a Bank of England and ECB point of view, that whatever it takes mantra it seems to be paying dividend, at least at this point in time. So again, upside trading just around 3.5 ticks shy of that 2100 now in the S&P, and 28 respectively Euro stocks, and 95 on the upside to watch in the DAX. Looking at today's session, it's kind of the run-in now to the main data point of the week, possibly the month, that being non-farm payrolls, which we'll get tomorrow. Now, if you remember, yesterday ISM non-manufacturing was quite outstanding actually. It was way above the top end of the analyst range, and a big surprise, just given the kind of economic sentiment is so negative at the moment. That was a welcome relief to the market, and really this equity bid we've seen this morning, that was really the catalyst to start lifting US equities off those lower levels. In terms of later on this morning, you do have UK industrial and manufacturing production. However, these are May readings, so this will be pre-referendum, so I'm not expecting it to have too much of an impact on the pound. Later on though, the big figure of the day will be ADP employment change, often seen as a good precursor for non-farm payrolls on a historical basis. However, this is a quick look at ADP. So it's been a fairly consistent pattern, I would say, over the last 5 months here in ADP. I guess on an average basis, that's something like 190 or around those levels. But if you look at the last print of ADP, you had 173,000. Can any of you remember what the headline reading for non-farm payrolls was for last month? 38,000. So if you're talking about using ADP as a barometer for potentially what NFP might come out, then that correlation completely broke down last month. So, when you're looking at things like employment constituents of the ISM readings, challenger job cuts, the weekly jobless claims, ADP, these are all indicators to watch to try to gauge the kind of the market positioning ahead of non-farms, but by no means are they an exact science to kind of give you the correct number, let's say, when non-farms is due. Again, non-farms massively underperformed the ADP print. Again, we'll go into non-farms a bit more when we get closer to that tomorrow. But otherwise, wrapping up today, you do have the weekly jobs data coming out 1:30 from the US. Department of Energy numbers, they will be key as well today. So your two main things you're kind of looking for from a calendar point of view is 1:15 for ADP and then 4 o'clock for the oil inventory numbers. Speaker-wise, you do have ECB's Lautenschlager, leaning hawk, speaking at 11 o'clock this morning. Constancio is the Vice President of the ECB, not speaking till after European markets close. But you do have Villeroy this afternoon. In terms of fixed income, now if I'm looking at Bunds this morning, let me just try and get a Bund chart up so I can talk about this with you. So Bunds already on a bit of the back foot this morning. That's mainly predominantly down due to the equity strength that we're seeing. However, let me just share with you the calendar again. This is why preparing with your calendar is really important. Now, looking at 9:30 and 9:50 specifically, you have the Spanish and the French Treasury issuing a very large amount of debt. 4 to 5 billion coming out of Spain and 9 to 10 billion coming out of France. Cumulatively, if you were to equate that to Bund future contracts, that's about 153,000 new Bund future supply hitting the market this morning. Simple supply and demand theme then, if you put it in that context, the market pre-positioning ahead of the supply, you often see some movement in the futures market from the open into when these auctions results come out, which is around 10 o'clock. Some short setting. So in combination with the stock strength in that inverse correlation with Bund futures, so that's putting it on the back foot, but put it cumulatively with a large amount of supply hitting the market from Spain and France this morning. These are things in which traders who trade fixed income futures like the Bund will be looking at. Couple that then with technicals, with the move through the break of yesterday afternoon's low. You can see that wick initially ran lower, comes back to that point now. There could be potential here for further downside as traders front run ahead of that supply hitting the market. So just something to bear in mind. These are things I look at on the calendar, and you should do the same also if you are trading Bund futures for sure. Quick wrap up as well. Anyone who follows our Facebook group would have seen a very good article shared by Will DeLucy last night. I do suggest you take a read. It's the link again is on our Facebook page. It's about backgammon and talking about it from a trading point of view and risk. It's a very interesting read because it's talking about with backgammon. It's all about making very quick decisions and making a judgment call, when to play it safe and when to take a gamble. And the more you play it, the more of a feeling, the more intuitive it becomes, and it helps you calibrate you for risk taking and getting comfortable in those scenarios. This guy that's written it, I think he was a Nobel Prize winner, but he's talking about the beautiful thing about the game of backgammon is it teaches you about brain chemistry and winning and losing. And when he was in a bad place in his life and his spirits were low, he would play the game badly, but if his spirits were up, then he would win. And it was a question of how do you generate the spirit to win? And he offers some practical pointers, and he can tell you the tricks to win the game just by resetting kind of your mind frame and doing simple things. Now, these are all things you would have heard before, but I think they're things that you guys as traders, these are practical points which I think you can implement, which can make a difference. He says things like, well, he's talking to the interviewer, and he tells him to relax, watch his posture, put himself in a winning frame of mind. In backgammon, he's saying hold the dice, make yourself big, don't hunch, keep a wide stance, because you're competing against another person's energy. These are all things which can be translated into what we do in looking at the financial markets. Talking to some of the new guys, getting used to the systems on the internship in the month one, and they're making consecutively losing trades, but it's kind of having the mentality of the amount that they're dwelling on these negative outcomes. They also need to do it with the positive outcomes, remembering how you felt when executing a correct strategy or a trade to perfection, and how you envisaged it. What was your frame of mind? What was your thinking? What was your preparation? How did you execute it? How did you feel? What was your body language? All these things are things that you should be constantly ratifying in your head, and reaffirming positive behavior. So a good read. As I said, I'll share the link into the HotCom room, but you can jump on the Facebook group as well if you don't have access to HotCom. Okay guys, that wraps up the briefing then for this morning. Thanks for listening. Have a good day. Again, ADP 115, all inventory data at 4 o'clock, key things to look out for. But have a good session.